Section 1. The promise of clarity. If your income is strong but your lender says your file is complicated, this is for you. That single word, complicated, can feel like a roadblock, a polite rejection dressed up in industry jargon. It suggests your success, your diverse income streams, your sophisticated financial planning are somehow a problem. But let me be direct. Complexity is not a disqualifier. It signals you've moved beyond one-size-fits-all lending. Your finances are not the issue. The lender's limited perspective is. Section 2. Decoding the disconnect. Let's pull back the curtain and look at why so many lenders stumble when faced with a successful, multifaceted financial profile. The standard mortgage process in the United States is built for maximum efficiency and minimum risk, designed around the traditional 9-to-5 employee. Underwriters are trained to look for predictable, consistent income, documented by a W-2, 2 recent pay stubs. This model works for many, but it creates friction with an executive, entrepreneur, or seasoned investor. Their systems are simply not programmed for your world. When they receive K-1s from multiple businesses, they see fluctuating profits and pass-through entities requiring manual analysis. With RSUs and performance bonuses, they see variable income that doesn't fit neatly into a monthly calculation. A portfolio with 10 properties triggers high aggregate debt flags before offsetting rental income is captured. It's a classic case of the algorithm failing the nuance test. Smart write-offs reduce AGI, which looks low to a checkbox underwriter despite strong cash flow. They operate within rigid frameworks that prize simplicity and predictability. Section 3. The K-1 Conundrum. For partners, owners of S corporations and partnerships, the Schedule K-1 communicates your share of business performance. To an untrained eye, it can look like a jumble of codes and figures. Standard lenders see uncertainty. Skilled ones analyze what's stable, likely to continue, and available for debt service. Lenders want a 2-year history and typically average earnings. Consistency is king. A big profit followed by a loss prompts questions. Steady or rising income builds a strong case. They may ask for full business returns and cash balances to validate liquidity and ability to pay distributions. Your share of net profit is not the same as cash you take out. We must show a history of distributions. Ownership matters. Majority control implies access. Minority stakes require proof of consistent payouts. Don't just hand over K-1s. Include a CPA letter on stability and liquidity, business bank statements, and explanations for one-time fluctuations. A major investment might lower distributions temporarily, but set up stronger future growth. Provide context, and replace uncertainty with documented confidence in your income stream. For many executives, a significant portion of total compensation isn't a weekly paycheck, but equity. Restricted stock units, performance-based bonuses, and other stock awards are powerful wealth builders but confuse mortgages. Lenders value consistency. Stock pay is variable, driven by company performance, vesting schedules, and markets. The key is a reliable history and high probability of continuance, turning maybe into predictable income. Let's talk RSUs. Grants vest over time. Unvested shares don't count. Track record required, typically 2 years. Example, grants in 2023 and 2024. Units vest and convert to cash both years, and the underwriter establishes an average. Underwriters review vesting events, sale proceeds, project future income, and apply a conservative haircut. Bonuses are similar. A one-time windfall is hard to use. A contract with a target bonus plus 2 to 3 years history can count. Consistent bonuses of $200K, $250K over 3 years make a strong case. Lenders average past amounts. Presentation matters. Award letters with vesting schedules, brokerage statements, and a VOE confirming salary and equity structure. Quarterly vests with consistent liquidation patterns look stronger than a single annual event. Connect the dots. Show equity as real cash flow, not just paper wealth. For many successful investors, owning multiple properties is a cornerstone of wealth, but it can trigger alarms in underwriting. They see cumulative debt, and jump to a high debt-to-income ratio before capturing income. Shift focus from gross debt to net positive cash flow. Documentation clears this hurdle. Start with meticulous accounting per property. Show gross rent with leases and 2 years of Schedule E. Lenders use about 75% of gross rents to cover vacancy and maintenance. Itemize PITI: principal, interest, taxes, insurance, plus any HOA dues. If lender calculated rent exceeds PITI, that positive cash flow can be added to qualifying income. If PITI is higher, the net loss counts against monthly debts. A clean, property-by-property spreadsheet is invaluable. Reserves are crucial. Show liquid assets covering months of payments for vacancies or repairs. Target 6 months of PITI for all financed properties, in savings or investment accounts. Present holdings as a self-sustaining business with cash flow and reserves, turning red flags into green lights. Self-employment powers America and complicates mortgages. Tax efficiency lowers AGI, which can understate your true earning power on a loan application. The gap between cash flow and taxable income is where applications fall apart. Fortunately, there are sophisticated solutions. Skilled underwriters add back non-cash expenses like depreciation and depletion, but reinvestment can still mask strength. Enter alternative docs. Bank statement loans using 12 or 24 months of deposits to derive income. Example: $100,000 per month deposits with a 40% expense ratio can qualify as $60,000 monthly income. These are often non-QM, outside Fannie Freddie, designed for creditworthy borrowers with non-traditional income. Options include asset utilization loans and P&L-only programs. Key takeaway: tax returns aren't the only story. Use bank statements and a CPA-prepared P&L to reflect your success. Choose a lender who can read the right story. In the mortgage world, it's easy to fixate on rate. For simple W-2 buyers, that can work. For executives, investors, and business owners, it's a mistake. Structure, lender capabilities, and advisor expertise matter more than a quarter point. A denied loan at 6.25% is more expensive than an approved loan at 6.50%. You wouldn't pick a builder on price alone. You'd pick the one who can execute your complex design. The right strategy matches lender and loan to your K-1s, RSUs, and bank statement cash flow. Secure approval first, optimize rate second. Strategy matters more than rate. That might mean a portfolio lender, a non-QM bank statement program, paying off a smaller debt, or using an LLC. These are strategic moves a rate-only call center can't handle. You need a mortgage professional, a financial strategist. If your finances are complex, your loan strategy must be intentional. With the right approach, high net worth buyers have more options, not fewer. Take control of the narrative, find a partner with the full toolkit, show your full financial story, and turn complicated into approved.